Welcome to this explainer. Today we're breaking down a monumental structural shift in Indian fixed income that, honestly, most people completely missed. Back in June 2024, something happened that is quietly altering the very foundation of Indian finance. And it's going to affect everything, from your mutual fund returns to the exchange rate when NRIs send money home. We are looking at a massive wave of capital entering the country.
Look at this number. We are talking about $50 to $70 billion. That's roughly 1.5 to 2 lakh crore rupees flowing directly into India on absolute autopilot. This isn't speculative day trading money. This is passive institutional capital that is effectively mandated to enter the Indian market over the next couple of years. It's a staggering number, and it represents a historic shift in exactly how global institutions view India.
Now, you might be wondering, why should I care about institutional flows? Well, the crucial point here is that this massive influx is going to directly alter the financial reality for both resident Indian retail investors and NRIs abroad. This isn't just a headline for billionaires or hedge fund managers. Whether you're wondering if you should shift some of your debt mutual fund allocation, or you're an NRI trying to figure out if you should lock in your fixed deposits right now, this explainer is going to give you the concrete, practical answers you need. So, here is our roadmap for this explainer. First, decoding global bond indices. Second, the inflow domino effect. Third, strategy for retail investors. Fourth, the NRI investment playbook. And finally, number 5, hidden risks to watch. All right, let's jump right into part 1, decoding global bond indices.
So what exactly is a global bond index? Think of it like the Nifty 50, but for global debt. It's essentially a benchmark maintained by major financial institutions, pension funds, insurance companies, sovereign wealth funds. They use these indices to decide where to park literally trillions of dollars. When a country's bonds are added to a major index, the passive funds tracking that index are practically forced to buy in. It's an automatic trigger.
And to put the scale of this into perspective, the expected inflows across 3 major global indices are honestly staggering. First up, we have the JP Morgan Government Bond Index for emerging markets. They're phasing India in at 1% per month up to a 10% cap, which brings in an estimated $20 to $25 billion. Then, starting in early 2025, the Bloomberg Global Aggregate Index is going to bring in another $5 to $10 billion. And waiting in the wings, FTSE Russell. If they move India from their watch list to full inclusion, that could trigger an additional $30 billion plus. But here's the catch. Foreign investors aren't just buying any random Indian debt. They are strictly targeting FAR bonds. Back in April 2020, the Reserve Bank of India launched this fully accessible route. These are specific government securities, or GSECs, designed with zero investment limits for foreign buyers. Honestly, this was the masterstroke that made India eligible for these global indices in the first place. As you can see here, FAR bonds only make up a specific slice of India's massive 100+ lakh crore government securities market, roughly 25 to 30%. The global indices are not buying state bonds or corporate bonds. They are exclusively purchasing this specific, fully accessible slice of the pie. Okay, moving on to part 2, the inflow domino effect. Let's walk through the exact mechanics of this chain reaction, because it directly reaches your bank account. Step 1. The index inclusion happens. Step 2. Passive foreign funds are forced to buy rupee-denominated bonds, triggering massive institutional inflows. Step 3. Because they literally need rupees to buy these bonds, demand for the Indian rupee increases, which brings stability or even appreciation pressure to the currency. Finally, Step 4. As foreign demand pushes government bond prices up, their yields fall. And since banks price their loans off these government yields, this structurally leads to lower borrowing costs and, eventually, lower EMIs for the average consumer.
Now, I want to debunk a major myth right here. I hear people say all the time, well, if all this money is flowing into bonds, won't the Indian equity market crash? Actually, no. It's completely backwards. This bond market boom is actually a powerful structural tailwind for Indian stocks. A supported rupee and lower government borrowing costs reduce the overall cost of capital. And when the cost of capital drops, equity valuations historically get a major boost. So, what does this mean for your wallet? Let's dive into part 3, strategy for retail investors. While you, as a retail investor, might not go out and buy these specific FAR bonds directly on the institutional market, you can absolutely capture the upside of these foreign inflows through specific domestic mutual fund categories.
Gilt mutual funds, which hold government securities, are perfectly positioned for this. Long-duration debt funds similarly benefit from these macro shifts, as do dynamic bond funds, where the fund managers actively adjust for these yield movements. Also, definitely keep an eye out for FAR-based target maturity funds that track these exact eligible bonds. It all boils down to this absolute golden rule of fixed income. There is an inverse relationship between interest rates and bond prices. As $50 billion of foreign demand bids up the price of Indian government securities, the yields on those bonds naturally fall. And when bond prices rise, the net asset value, or NAV, of your existing debt funds goes up. This dynamic has historically generated really strong returns for gilt fund holders during similar inclusion events globally.
Let's shift gears to Part 4, the NRI Investment Playbook.
If you're tuning in from Dubai, London, or New York, here's your exact cross-border action plan. First, because overall government yields are falling due to this foreign demand, Indian banks are likely going to reduce their fixed deposit rates over time. So, you might want to lock in longer NRE FD tenures right now while rates are still relatively attractive. Second, consider using the RBI Retail Direct portal for your bond investments. And third, if you hold Indian equities in an NRE demat account, stay the course. You're directly benefiting from the rupee stability and those equity market tailwinds we just talked about.
And let me clarify a massive point of confusion. A lot of NRIs think they can just log in and buy the exact same FIR bonds through the same route those global indices use. Actually, scratch that. It doesn't work that way. The FIR route is strictly exclusively for institutional foreign portfolio investors. However, as an NRI, you have a completely separate, dedicated, and honestly incredibly simple channel to buy government debt, the RBI Retail Direct scheme. It lets you buy GSECs, T-bills, and state development loans seamlessly online.
But remember, no matter where you live, the tax man always wants his cut, right? Interest earned from GSECs in India is subject to Indian tax deductions. So always check your specific double taxation avoidance agreement, or DTAA provisions. If you live in a place like the UAE with no personal income tax, you can get full DTAA benefits. If you're in the US or UK, you're going to need to disclose this interest on your global tax return. Just talk to your tax advisor to make sure you aren't being taxed twice on the same money.
All right, bringing it home with Part 5, Hidden Risks to Watch.
Look, to keep this explainer completely objective, we have to talk about the downsides of relying on foreign capital. Because debt funds move inversely with interest rates, they carry a very real reverse flow risk. If global inflation suddenly spikes or global risk appetite just drops, foreign investors might pull their capital out of Indian GSECs. If they sell off rapidly, bond prices will crash, yields will spike, and those beautiful gains in your gilt fund NAVs can reverse in a hurry. Plus, any major currency depreciation could wipe out returns for foreign investors, which would only accelerate their exit.
So, we've seen exactly how this multi-billion-dollar inclusion mechanically works, how it stabilizes the rupee, lowers borrowing costs, and ultimately provides massive opportunities through gilt funds for residents and NRE FDs for those living abroad. I'll leave you with this final thought to help you rethink your own fixed income allocations in light of this once-in-a-generation market shift. With $50 billion of global smart money quietly pouring into Indian bonds on absolute autopilot, is your portfolio positioned to catch the wave?